we're summarizing that, high inflation is good for rent growth. It's also good for home prices. And someone who follows real estate or even, just casually just looking at, single family home prices, they might scoff at the above or, what I just said and saying that, well, the crash or correction has already started.
I'm Drew Breneman, and this is the Rise and Invest podcast. I bought my first two properties as a 19-year-old with my own money that I earned from an online business I started in high school. I've now grown my portfolio from that first duplex to hundreds of millions of dollars of investment property. My goal with this show is to give you the resource I wanted when I first started out. Subscribe to our podcast where I break down real-life stories, tactics, strategies, and current market information you need to be a successful investor.
Welcome to the Rise and Invest podcast. If you're watching today, you see we're doing something a little bit different than some of the previous episodes. We're shooting more of a remote style episode today. I want to try out something different. Going to try to open up the pool of guests where if we can do these remote, that would help do that. So shooting one today with Evan Dillon, we're in the same office today. So we're just to try it out. So
yeah, thank you for having me. We are fully mobilized and ready to go worldwide, I guess, with the power of the internet.
Yeah. So then this way, so far every guest they have to be in Chicago if you're going to shoot it in person. So I think this was a good first step figuring this out. And then two, I think something I haven't really mentioned before much, but I need to start asking you guys all if we could. It would help a lot if we could get more reviews of the podcast. Just help others to share it. So if you're wherever you're viewing or listening to the podcast, if you could leave a review, just anything brief would help get the word out, feed the algorithm on whatever platform you're on, just to get the podcast more out there. And today we want to shoot something that's really topical. We've seen online and then kind of been wondering to ourselves, like people talking about, okay, well, interest rates obviously went up, inflation is really high, and then what happens in those times, with interest rates and then multifamily rent growth, or what's the correlation with inflation and multifamily rent growth? So we've dug into that, and then also we went back and looked at the 1970s to kind of see how did things perform when there was inflation and a recession. So we're gonna dig into that today, and then that's why I think it's nice to try this this remote style recording, because we can also put things on the screen. So if you're not watching, that's fine. We're gonna paint a picture with our words here, so you don't need it. But if you're watching on YouTube, you can see what the charts that Evan made. So, and two, I think Evan, if you could, why don't you? I think you're our number one guest. I would think at this point by episode count, but why don't you just reintroduce yourself?
This might be like episode 5 or 6 with me on, but I'm Evan Dillon, VP of Investments here at Rise Invest. Been working with Drew for about a year now. I've been in the private equity real estate space for probably like 6 years now. And actually before I joined the team here, I was working at a large institutional private equity firm, did about $2.5 billion worth of transactions over my 4 years, spanning all asset types, all investment strategies, both equity and debt. Not only, did I do a lot of acquisitions and transactions, but also did a lot of data analysis about real estate. And it's one of my favorite things to do. Do it for work a lot and sometimes for fun. So it's good to be back on the show.
And it was interesting when we met, and I know we had a March Madness episode, but at some of this, and it's kind of relevant to what we're going to talk about, where so what are some of the stuff you were doing with sports analytics? What were you doing in your
one of my personal obsessions has always been sports, and I guess I wasn't gifted with the natural abilities necessarily, but I have applied my analytical capabilities to understanding sports better, namely in college basketball. So I've developed a rating system and then a March Madness bracket optimization model that is used to optimize your chances of winning a March Madness pool. And we have a whole podcast talking about it, an hour and a half of, you know, deep dive basketball analytics. But predictive analytics has always been something that I've been very interested in. And then not only that, but like optimizing, your chances of return, whether that be a March Madness pool or analyzing real estate metrics for the betterment of our investors and maximizing our returns.
Yeah, and so Evan's the person when we want to figure out like how would inflation and rent growth be correlated. He's the best one for that, where he's doing things like that, for real estate normally, and then also on for all sorts of sports, especially that NCAA bracket model, which was one of the crazier things I've seen. I still remember where we got formulas that are 7 lines long in Excel. But nice. And then two, real quick, I think just to mention our website. So you can go to riseinvest.com. We have a ton of resources on there. We have a blog. As one of them, we just recently put out a blog on top 10 tips on managing a construction project, not as the general contractor or the person who is doing everything, just from more of an owner perspective, how to manage the general contractor owner relationship, how to handle payments. So that's our latest blog on there. We also have a portfolio section, which has information on all of our properties. And basically, it's like a mini case study, a few paragraphs in each deal if you want to learn about how each deal went down. And then we have a trends report, which you can download, just showing the latest trends in real estate. And then also our passive investing guidebook, which that has all sorts of terminology and different parts of investing in real estate explained, but really geared more towards a passive investor. So let's say a passive investor would be someone, they're not doing the deal themselves. They're trying to keep their time available and not, basically create a second job for themselves. They want to just invest money and not get any more headaches. So that we have everything in there, from the basics on how these deals make money to how some of the tax strategies work even. So I think that's something that we all spent a lot of time on putting together. Evan was a huge part of it. So just want to mention that while we got Evan on here. So yeah, let's just jump into it. So then, Evan, we wanted to start out and find out what happens with rents at times of inflation. Is there any correlation with inflation and rent growth? And then two, let's try to explain this as sort of as basic as we can. Like let's even define correlation or what we would be looking for. So why don't you?
Yeah, sure.
Right in.
So, Drew summarized kind of the question well, in that we wanted to analyze, large time series of data going back to however far we can go to get a sample from the U.S. economy in all different conditions. So times of expansion, times of contraction, times of high inflation, et cetera, et cetera. So this analysis is composed of publicly available data from a website called the Federal Reserve Economic Data, or FRED for short. FRED has hundreds of thousands of time series for all kinds of data and indices, and that spans, international, national, and even like market specific. So we can evaluate things like individual demographic and economic data by individual MSA, which has been very helpful. It's quickly become one of my favorite sources for when performing data analysis, because the data that's available is very robust and it's very easy to download. So if data analysis is your thing, the listener, I would definitely recommend trying out the website. And, we've been doing a lot of granular analysis for individual markets across the U.S. And maybe we jump into that on another podcast. But today we're kind of focusing on metrics for the overall U.S. market. So we've compiled a set of data time series dating back to the 1960s. So like I said, this data is quite robust. and is representative of nearly all conditions of the U.S. economy. Some of the data that we gathered are include CPI, obviously, because we want to understand inflation better, the 30-year fixed rate mortgage average in the United States, um, the index for rent of primary residences in the U.S., and we can use this to calculate rent growth. Rental vacancy rates, median sales price of houses sold in the U.S., and then the S&P Case-Shiller U.S. National Home Price Index. So we compiled each of these indices and then aggregated them. And we wanted to understand the correlation coefficients between each of these variables. So all of this can be done in Excel. And there's actually a function called data analysis in Excel that lives up to its name, doing data analysis. But that function is mostly geared towards understanding the relationship between two variables. So when we aggregate a list of data and we can have column by column of these different variables, we can then use that data analysis and then correlation function to understand what the correlation is between each of these variables. So a correlation coefficient is it's a statistical measure just used to quantify the strength of a relationship between two variables. And this is portrayed as a value between 1 and -1. So 1 meaning that there's a perfect positive relationship. So as one variable goes up, the other one goes up as well. Or it could be the flip side, where as one variable goes down, the other one goes down as well. This is opposite of this correlation coefficient of 1 is a direct opposite of -1, which would mean that there's a perfect negative relationship where as one variable goes up, the other goes down. And then vice versa, if one variable goes down, the other goes up. And then between that is 0, which means that there's no relationship between between the two variables, and there's really no takeaway. But some of the findings here that I wanted to highlight was that one of the strongest relationships that we found was that of CPI and rent growth, with a correlation coefficient of 0.69. Meaning that as CPI goes up, so does rent growth, with quite a strong relationship. And, I'd say this relationship is pretty intuitive. But, this is really really important to point out right now, just as, the market anticipates how to best approach, these times of rising interest rates and high inflation and a looming recession and how it'll ripple through the economy. The biggest question, obviously, is what effect will there be on rents and rent growth, which are two of the most important inputs when it comes to underwriting and modeling. So, with a looming recession in mind, or at least some market turbulence, I think the first inclination for someone to have might be that, okay, recession equals contraction, contraction equals negative rent growth. But not all recessions are equal. And, this period that we're in right now is defined by high inflation. So all else being equal, the expectation should be that rent growth should remain high and be consistent with the high inflationary environment we're in right now.
Yeah, and one thing too to jump in on, this is something that's in our passive investing guidebook. We talk about this is related, but with correlations, not with inflation necessarily. But private real estate, buying individual properties, it has a really low correlation with other investment types. I don't have it open or memorized, but it was much closer to 0 than it was to 1. Let's say real estate with the stock market or with bonds or other investments. I mean, from memory, I think both were below a 0.2, and with 0 meaning there's zero relationship, and so not a strong one. And it's interesting to see even anecdotally, and depends on the market. But in one of the markets we look at, in these some of these recent weeks, a month or two ago, when the stock market was really taking a beating, I was talking to a multifamily broker and asked him how things were going, and he said fine. Just no one was really looking too hard last week because they were watching all their stocks fall. And I asked him if he thought it impacted pricing, because you'd think eventually it would if everyone sort of loses their down payment in the stock market or something, or he thought no in that market. This is less sensitive to interest rates. That's Chicago, where the unlevered yields are a lot higher, so you're a little bit less sensitive to debt, and there's a lot of long-term owners. But that was it's interesting because we have that in the guidebook, and then I have a real phone call where it's like, wow, this really isn't correlated, and it depends on the market. Some other markets where you're really banking on high growth, I mean, those are going to have different outcomes if people are not sure about the growth, or you can never get it stabilized to a yield above your interest cost, and interest cost just went up. But so that's this kind of a thing to add. And then so a 0.69 correlation was CPI to rent growth is what we found.
So that was a period between 1964 and today. So almost 60 years.
Yeah, a lot of time in there, and that we got the times where there's recessions, there's economic expansion, there's high inflation, there's low inflation. So I mean that it's nice we're able to get that data, and then obviously the calculate. What have we learned? Is there a cutoff that you have in your head, Evan, on like what would be a strong correlation with something? So obviously, if it's 0, there's no correlation. But if it's a 0.4, are we thinking that's strong, or what would?
Yeah, I mean, I think it's important, when we do this analysis and come up with a correlation coefficient. I think there's always more than meets the eye with just a single number, and I think we'll kind of get into this on the next variable that we saw a strong correlation with. But it's really up to the beholder. I think there's a lot of noise out in the real estate world, and there's innumerable number of variables to calculate, and it can be difficult to find the signal within the noise and find those strong correlations. So right now, I mean, in analyzing the variables that we did compare with each other, I mean, there's not many I'd say variables that do correlate well with each other. So when you do find one that has a strong relationship, such as a 0.69 correlation, which would be like an R squared value of like 0.3 or 0.35 thereabouts, that's a pretty strong relationship that we can take away from. And I think this kind of gets into my next point where another really strong correlation that we found existed between rent growth and growth in the Case-Shiller home price index. So just the appreciation rate of homes. And we found that the two moved very similarly, although the rent growth fundamentals actually lagged behind that of the single family homes. So when we just did the correlation analysis at first, that correlation was pretty weak. But then when we plotted it out on a chart and visualized both fundamentals moving side by side, they actually, the movements were the exact same, except there was a little bit of a delay. So when we accounted for this lag, we got to a correlation coefficient of 0.72. And that's the strongest relationship to come out of doing this analysis. Intuitively, I think this makes a lot of sense that housing fundamentals, whether single family homes or just regular apartment rentals, I would think that they would be closely related, but still, some may be of the impression that heightened demand in one space or the other might be detrimental to the other. So I thought that was a pretty interesting one.
Yeah, and for it's interesting. I mean, for me, that's not an intuitive relationship where I sort of came up in the 2005, 2000, like 2005 was when I bought my first rental property. And so I'm coming up in a time period where there's actually, it seemed like everyone who could rent, unless they were a college student, they were trying to buy back in 2005, 6, 7. So that's sort of where I got started and was like, I would have thought were not that correlated. So that was a surprise to me, just based on the anecdotes I had been hearing and seeing, all through the early years of my career, where it was, you do find all your renters were moving out to buy is how it felt. Um, it's just that was, not actually what the numbers were saying. Really, what was happening then is fine. They moved out, but then as prices kept accelerating, then someone who I guess couldn't buy is moving into your unit, and then just everything is moving up, which that makes a lot of sense. So then when you sort of think back on it like that, that does make sense. Whereas actual home prices move up, rents should follow right behind it because that's the alternative. And then just as a country, like more people are owners than renters, so then that's going to move the needle as well. Um, so yeah, interesting. And then any other thoughts on that, Evan? Or
No, I mean, I think you hit it on the head, and I think you talked about the correlation coefficients for real estate relative to other asset classes, and I think it makes sense that you know uh, the real estate returns may not be so well correlated to like the S&P 500 or you know bonds or any other type of asset. But so it makes sense to me that real estate fundamentals, whether it be rent growth and then single family home growth, I would expect to see a higher correlation there, just because they're so closely related. Um, and I guess one of the, I think one of the last correlations that I want to talk about here that it's a surprisingly weak correlation, and I think knowing that relationship is, I think, just as important as knowing that there is a high correlation between two variables. One of the things that you brought up at the very beginning of the podcast, and something that we've contemplated, and many other investors I know are contemplating, is the idea that higher interest rates equals less homeowners, and then less homeowners equals more renters. More renters equals stronger demand for apartments, and then the stronger demand equals higher rent growth. So what we did was we measured the rate of change of the 30-year fixed rate mortgage average in the U.S. and then compared that to rent growth. And it was surprising to see that the correlation coefficient here is positive, but it's very weak, like I said, of a value of just 0.3. So I think that kind of goes against maybe the at least the popular talk of these rising interest rates are going to create more demand for apartments, at least historically. It doesn't hold up historically, but I think we can kind of get into why it could be different this time, and just in showing some of these visualizations.
yeah, and it's been interesting just reading what others are saying on LinkedIn or Twitter or wherever, or just talking on the phone, where a lot of people think, um, yeah, what you said, where higher interest rates, that it means less buyers of property, then that's going to equal more renters equals higher rents. And then it's interesting that wasn't actually necessarily the case. Um, Especially we're looking at the other things where something much more indicative would be the housing market appreciating. So that was a surprise to me. And then I think it's interesting the correlation between inflation and rents. That makes sense. It's something everyone always talks about, but it's one of those things where, oh, you want to be in hard assets when there's times of inflation. Like you hear that everywhere at all times. And then, you kind of wonder, well, okay, that makes sense if you, from like a cost to build standpoint, where obviously if you were going to rebuild your building, it costs a lot more when there's high inflation. but you're not rebuilding it. You own it, and you need to make repairs and pay bills, and those are also increasing. So it was interesting to see, because that the CPI and rent growth was so correlated. Evan, I think we put some visuals together, or do we make any visuals for this?
Yeah. And before I share my screen, I kind of just want to summarize everything that we went over, where there's a really strong correlation between CPI and rent growth with the correlation coefficient of 0.69. Also, a really strong relationship between rent growth and growth in home prices. And then a fairly weak correlation between rent growth and the rate of increase in the mortgage rate index. Um, so, that might be, we're summarizing that, high inflation is good for rent growth. It's also good for home prices. And someone who follows real estate or even, just casually just looking at, single family home prices, they might scoff at the above or, what I just said and saying that, well, the crash or correction has already started. The jury is still really out on what's going to happen with rent growth, but we're already seeing single family homes falling out of contract, listings going up, price decreases, etc. But to kind of put things into perspective, and I'm going to share my screen here. So this chart identifies the 30-year fixed rate mortgage average in the U.S. As a form of a blue line going back to the 1970s through today. So in just following this index, I can calculate. One of the things I really wanted to calculate was the rate of change and how severe it may have been in this last few months with just the significant rate increases that we've seen. So I have the mortgage rate index in blue here, and then in orange, this is the percentage increase per day required to reach the forward-looking maximum. So, with rates, today at 5.5 or thereabouts, they were probably close to, 2.5, 2 3/4, just about a year or 18 months ago. So actually, this recent increase was actually the largest rate of increase ever on record, or at least during this time series. So going back 50 years, this rate of increase is actually 4 times greater than any sort of rate of increase that we've seen in the past. So, I think this really puts things into perspective because we've never been in an environment like this where rates have increased so dramatically in such a short period of time.
And then real quick, Evan, for anybody who's just listening, what we're looking at, it's a chart, but what the main takeaway on it is we have the interest rate at the time mapped out, and then also the daily the change, the percentage increase per day mapped out, and the highest percentage increase per day ever on this chart was back in until basically now was back in the 80s when it got to 0.10%, so 10 basis points, and then it a couple times got to like 0.1, and then in this recent year or so, just to keep it simple, we started getting as high as 0.5%. So we're not, it's unprecedented. We're looking at a bunch of little ups and downs, and then there's like a Mount Everest at the end of the screen here for what we're going through. So to Evan's point, it's like we're not so much in the prediction business on this podcast, but we want to get you guys the information where, this was very surprising because, you think, okay, it's some people, they're not buying properties now. They want to see what happens. And then what do we make of that? And it makes a lot of sense when you look at this chart. You go, okay, this chart goes back to 1971. I've been doing real estate since 1971. I've never seen anything even barely 1/5 as big as this change we're having. So then what do I do? And you can see why people would give pause, or if you're going to be buying a house or apartment building and your interest rate was going to be 4.0 and now it's 5.5, maybe you change your plans now, and you're very startled by that. So be interesting to see how things shake out. But just to kind of give that color, just if you're listening only, so you're not. It's with that description. I don't feel like you're missing anything at this point.
Yeah, thanks, Drew. And like you said, now the market is really responding to this, and volatile inputs into the market or into the economy, such as like significant rate hikes, that will create volatile results. So what I mentioned earlier about single family homes falling out of contract, pricing decreases. And while we like observed a low correlation between the rate of increase in mortgage rates and rent growth, with something as dramatic as this, my expectations at least would be, there would be an increase or rent growth would benefit at least in the near term as single family home prices kind of correct themselves as a result of these significant rate hikes.
Yeah, it makes a lot of sense. And then I think too, also that one thing that's interesting in real estate is that it's really like slow developing. Where you could more or less the same thing. We're shooting this in July. This is sort of what still was, if you look back on this chart, was happening in the earlier part of the year. I mean, we were seeing the cost of our debt go up when we were pricing out new deals, back in March even. But a lot of homeowners, they have 30-year fixed mortgages, or even renters, they're in there for a 1-year lease. Things is just not like an immediate response where the whole market can move. It's not like the stock market where you can just click a button. So be interesting to see how this shakes out too when you start thinking about sort of that time lag, or interest rates are up, but if you're a homeowner and you've been in your house for a while, I mean, you got to think basically everybody's refinanced at a really low rate. I know how low Evan's rate is on his house. He's not, that'll be tough to ever let that go now. Right. So then that's, that's going to be a factor, so then that's just, not changing things there for some people, or will be a little slower to develop. So that's something interesting too that I think about, because if you explain this to somebody who's like a stock trader or something, they'd be like, well, it didn't just happen immediately. And it's like, well, it's real estate's just slower in how things play out. So you can see these things coming and make adjustments on what you buy, what you're doing, but it's not just immediate. So it'll be interesting to see how things shake out. And then what I was going to say is just that I think the one thing that I was very curious about was what happened in the 1970s, because we've had a economic expansion for going on 15 years now, and pretty close to that, and so I'm just rounding, but and we have high inflation, and we're really due for a recession. So wanted to see what happened in the 1970s, because my parents, they got married in 1972, and they bought a house right around that time. And I remember my dad always saying, he's like, inflation, it was like 20%. This is just from memory, so it's not. But he's like, and interest rates are almost as high. If I didn't buy a house that year, I felt like I would never be able to buy one. And at the same time, the economy was about to go into a recession. And so I was real curious, what does the data give us for the 1970s? Because if we ever have any sort of time period that's similar to what we might be facing with inflation and a recession, it would be then. So we have that information. So let's hop to that.
So this next visualization shows CPI and rent growth starting in 1964 through today. So at the very right of the chart, so where we are today in 2022, you can see inflation quite high at 8%. And the only other time it's been this high, and the only period that can go back to, like you said, is the 1970s. So here I've kind of blocked off the early 1970s through the early 1980s, where inflation was greater than 6%. And you can see in this window, this orange line that represents rent growth, it was actually the highest it's ever been according to this index. So I thought that was pretty interesting to see. And that the two, rent growth and CPI, have actually been kind of attached for the hip for the last 60
Yeah.
years.
I know. I was actually just thinking that the correlation, I mean, you can see it in the chart, if you're listening, is just the two lines are moving real similarly. And then basically now we're on this chart, we have inflation hit over 8%. And the only time we're seeing something similar was in the 1970s. And that in the 1970s period has the highest rent growth of any time on the whole chart. So, I mean, that's reassuring in a way, because we even in this 1970s period, we went through a recession like around 1973 to 1975, and that just eyeballing it here, they were getting 5% rent growth during that recession. It wasn't keeping up with inflation, but I mean that's still significant rent growth, where a lot of folks would be happy to be seeing 5% rent growth in a recession. I mean, typically, people are thinking rents are dropping. Although it's interesting in this chart, really, there's no period where rents were really dropping in much. I mean, in 2010, there it bottomed out to zero. But so multifamily, just I mean, you can see it in the chart, or if you're just listening, the rent growth really never went negative in this whole time series we have, which that's just a realization I had now.
Yeah, and then I guess this next chart. So we talked about the relationship between rent growth and then the single family home market. So this chart tracks CPI relative to median home sales price growth, dating back to the 1960s as well. And I've kind of outlined this chart in a similar way as I did for the last one, where I want to just look at the last environment that we were in where inflation was as high as it is today. So, going back to, again, the early 1970s through the early 1980s, where inflation was above 6%. If you follow the median home sales price growth in this period, this was actually the highest sustained rate of appreciation over the longest duration that we've observed in this index. So over this 10-year plus or minus window where inflation was really high, that's the most that homes have ever appreciated on record.
Yeah, that story from my dad, maybe he had the right percentages and I just upped it to 20 in my head. But yeah, we're looking at a period in the early 1970s where homes were going up 12% a year, touching at the top there, and inflation was, in the 11s, so it's interesting to see it do so well, even considering there was a recession in there. And you can see the other recessions that occurred where there was a big drop in home prices, and or not big, I guess, just a drop. I mean, the percentages aren't that massive, where all of them are less than 10 in this, but the interesting to see, because that you can feel kind of reassured looking at these, going, okay, we have inflation, what's going to happen? And you're still gonna get growth. So it's surprising to see, for me at least, where I thought it would be, maybe it's like flat, and then you got to deal with the inflation. So in the, you're not gaining when you include inflation, but that's it's very, very interesting to see. So yeah, great job, Evan, on pulling all this together. And I mean, yeah, I think that's plenty, Evan. I mean, this was really, really great. It's glad we were able to find all the data, and glad you were able to calculate it. So I think just to kind of summarize kind of what we just covered too, like just real quickly, CPI and rent growth was a 0.69 correlation. So very high correlation. And in some of the charts we put up, you could see that too along the way over the years. Rent growth and the growth in the S&P Case-Shiller Home Index was a 0.72 correlation, so also very high. And then what was surprising to me, and I'm sure to a lot of people, will be rent growth, and the year-over-year mortgage rate increase was not highly correlated. It was a 0.3 correlation. And because you see a lot of people online saying, or just in the conversation, interest rates are go up. That means less home buyers. Less buyers means more renters. More renters equals higher rents. And over the last, since the 1960s, that has not been the case. Probably it's been the case, I'm sure, for short periods of time, but has not been the case over the long haul. We're going to put together a PDF download of this. Kind of just take what we already talked about and put together a download that's going to have the charts. So if you wanted to see the charts you weren't able to on this episode, those will all be in there. It'll take a little bit to put it together. So at some point we'll have it out, and then that will be on our website in the download section. So you can go to riseinvest.com/downloads, and it'll be in there. That's the same place our passive investing guidebook and the trends report is as well. So then you can kind of see the results for yourself and read it long form if you like. So great. Well, that's it for today. So until next time, thanks for joining us, and we'll see you on the next episode.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com, where we have numerous free resources and information that can help both active and passive real estate investors. Our 100-plus page passive investing guidebook, our trends report, and our blog are all available on our website. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.